Good evening, ladies and gentlemen, and welcome back to another episode of our Stock Market Brief Show, where we navigate the financial markets through the lens of technical and inter-market analysis. Today, we mark month-end and quarter-end, so we're going to focus on some bigger picture stuff, some pivotal macro charts, the state of the yield curve, and the critical interplay between oil and the S&P 500. So join me as we explore these opportunities in the market and unveil the latest monthly, quarterly, and weekly expected moves. We'll also touch on some gamma levels that are shaping the S&P 500's path. Let's get into today's episode. Alrighty then, welcome back people to the show. We're going to start off looking at a monthly chart of the S&P 500. Going big picture here, you're going to see some lines on my screen. It may be confusing, but it might not be for a lot of you because I share this chart frequently. This is going to set the tone. It's going to give us a good framework of what we can expect potentially down the road. I have a couple of charts here. I have the yield curve, which is the 10-year minus 3-month, known as that Fed staple of the yield curve. And we have the federal funds effective rate. Okay, we're currently in a cycle, right, where we're pausing rates. We were in a rate hiking cycle. Now everyone's waiting for those rate cuts. And I'm highlighting the times in pink that the S&P 500 has made all-time highs in all of these areas, including where we are now, while the market was in a rate hike cycle, and then also where we started to pause, including right here where we paused. And during these times that I'm highlighting, I'm also highlighting that at that same time, these were during periods where we had a yield curve inversion. And a lot of people have stopped talking about the yield curve inversion, but I'm sure they'll be talking about it again when it uninverts. Because if you look very closely at this chart, what actually happens when the Federal Reserve starts cutting rates? At the times that I highlighted right over here, you'll notice that the yield curve, right, despite market going to all-time highs, the yield curve starts to uninvert during the times where we start to cut those rates, including all the way here in 2019 to 2020. There will come a time where the yield curve uninverts, and there is a time coming where the Federal Reserve is planning on cutting rates. And as you can see, what has happened, more volatility came in the market. The same thing in 2000, the same thing in 2008, the 1990 recession over there, and we're sitting over here at very frothy levels. But the market is screamingly bullish here, and you don't want to just blatantly short the market and get your face ripped off. If I zoom in here and I look at the 10-year, 2-year yield curve, since it inverted over here in July of 2022, when it's below that zero line, I've noticed a very interesting correlation. When it goes deeper into inversion, the S&P 500 tends to rally. Take a look at the pink lines going down, or the purple lines, and you'll see the S&P 500 going up. Now, at that same time, when the yield curve starts to uninvert, the S&P 500 actually sees some issues. That's what we pointed out over here. I'm just zooming in more frequently on a smaller fractal scale. And I wanted to just call out here in the recent run-up in the S&P 500, we did start to uninvert, and very frequently today we saw a pretty nice rise, steepening, I should say, of the yield curve. Now, does this mean that it's going to fly up to zero and start to uninvert right now? No, that's not what it necessarily means. But if it is going to start to continue higher, is this where we're going to see the S&P 500 begin to take a little bit of a back seat? Let's take a look at loans and leases and bank credit. A simple way of looking at this year-over-year chart is just when the line goes down, we have credit growth contracting. When it goes up, we have it expanding. And what do we see now? We see a subtle little turn taking place over here, which could potentially be a positive sign. But there's something more important I want to point out specifically about this chart. Notice the gray shaded areas. And every time that we have the gray shaded areas, which is a recession, prior to that, we had a contraction in credit growth. That's pretty much every time. Now, I want to add that not every time we had credit growth contraction, we had a recession. Okay, so does that mean we're going to have a recession here? Maybe, maybe not. So let's take it another step. This now is applying the 10-year, 2-year yield curve to it, which we just previously pointed out on, that's the 10-year, 3-month. This is the 10-year, 2-year. Oopsie, let me fix that. Shabba dabba, here we go. What you'll notice here is when I apply the 10-year, 2-year to that very same chart, we go through the credit growth contraction, and at the same time we were contracting, the yield curve was actually inverted and it started to uninvert. It's like those jaws closed. And take a look at this gray shaded area. Well, our yield curve was inverted. It started to move out of the inversion. Our credit growth was contracting and we started to see those jaws close. Going over here in 2008, the great financial crisis, the yield curve was inverted. We started to uninvert while the credit growth was contracting and you saw those jaws close. We had a very small yield curve inversion here in 2019, right? We had a subtle credit growth contraction there and we started to see this uninvert and steepen and this just shoot down here too as well. And what do we see taking place here? Well, we're still in inverted territory and we're getting that credit growth contraction. So when this uninverts, are these jaws going to begin to close and are we going to step into another recession? And I think we just need to be aware that that can be a possibility. You can also take a look here during the same time. This is now the yield curve, the 10-year, 2-year, but instead of using the credit growth, the original chart that I showed here, loans and leases and bank credit, on a year-over-year basis, I am applying the federal funds effective rate. And you'll see when we're inverted, they pause, right? When we're inverted, they started to pause. When we were inverted here, right, we were paused. And when we're inverted here, you can see now we are paused. But when we started to uninvert, right, uninvert, this is where we started to cut rates, and we're already talking about cutting rates now, right? Their goal is to keep inflation down. But during that time, right, what everyone wants right now, it ended up in the history, looking back to the left of our screen, it wasn't actually a very bullish sign for the markets. So I think we got to really be mindful of that. Now, are they going to be cutting soon? Well, there's a possibility. If you take a look at the 2-year yield, this is what closely tracks the federal funds effective rate. And every time that you see the 2-year yield go under the federal funds effective rate during a rate hiking cycle, that's typically where they begin to pause their rates. And you can see the 2-year yield crossed below the blue line and we paused, it continued to head down, then we cut. Okay, you can see we crossed beneath it right over here. They paused and then started to drop, they cut. We went below it, they paused, went lower, we cut. And where are we right now? We're kind of floating sideways where rates are higher, potentially for longer, and we are currently paused. So the moment that we start taking that down, if it starts coming off, that might signal to us that we're coming to a rate cutting cycle, which so far the market is saying that they are pricing in September to get one cut. But there's other people mentioning that if inflation doesn't come off, right, they can hold rates higher for longer. And what's going to force them to cut? It could be potentially if something were to break, right, in the markets. And we got to also, once again, be prepared for that because we don't know if that's going to be the case. We can be sideswiped. We can be black swan. We can be this. We can be that. But just to note, it's very hard to prepare for those type of events, to time those type of events, but it's easy. Sorry, it's hard to time those events, but it's easy to prepare and be aware that those can be a potential situation. If you take a thing, if you look at liquidity, right, we'll look at total assets. Their balance sheet still continues to drain. This is part of the tightening cycle that we're currently in. Another way that we can look at liquidity is looking at reserve balances. And you can see here, it's never had a strong correlation, but in recent, when it started flying up, this blue line, the SP 500 followed, and pretty much in 2022, it followed to a very high correlated state. We started to come off here. So think of this as liquidity going down. The market started coming down. When it started going up, the market went up. And you can see it was pretty much a 1-for-1 correlation. And even when we started to flatten out here, the market went higher, but then it came back in. And I'm just calling this out now because if the correlation is going to hold, this has actually been coming off, right? We saw a little bit of volatility here. The market's been pressing higher, but that spread right there could give us indication that the market may be settling in soon in the near future. And that kind of makes sense because we talked about seasonality on our prior episode. We are coming into July through October, going this area, right, during this election year, the markets tend to flatten out, they consolidate, they pull in a little bit, and we've been seeing a pretty strong rally. So to see a little reversion to the mean or a consolidation may make sense coming up here. We also discussed this chart, but if you want to hear more about this specific chart from Tom McClellan, I would suggest going to just watch yesterday's video, but it was pretty interesting seeing this huge surge, then the market follows with a big response, and then it comes off, the market goes against the message, and the next step is typically a payback, but it's very hard to time those type of things. All right, I want to get into the oil situation and its repercussions and how it can potentially affect the S&P 500. So first and foremost, if I look at a chart of oil, right, this is the black line is oil. The line behind it is the 10-year yield. And I thought this was pretty interesting that oil has been kind of a leading indicator of the 10-year yield, meaning that when oil comes off, look at the 10-year yield, it followed there shortly after. When oil started to rise and find a bottom, the 10-year yield found a bottom and started to follow. Even in recent trade this year, oil started to find a top and the 10-year yield started to follow. And then in very recent trade here in June, oil started ripping up higher. And guess what? The 10-year yield just recently now started to follow. And I find this to be important because there is a strong correlation between these two assets. For one, the 10-year yield and oil, but two, there's a strong correlation between oil and energy stocks. And this is very important from a relative standpoint. And I'll get into that on the next chart. But you'll see here, if I'm looking at like a 90-day correlation between oil and energy, you'll see that it stays above that zero line with a pretty high positive correlation, meaning that if oil goes higher, you'll typically see energy names such as the XLE, the SPDR ETF, follow in bullish fashion. Now, what does that mean for the S&P 500? Well, let's talk about the S&P 500 from a relative standpoint. So if we look at the relative strength line between energy and the S&P 500, you'll notice that there are times where this sinks off and then the market goes higher, right? This is a chart of the S&P 500. On the flip side, when the relative strength starts to move higher, you get weakness in the S&P 500, right? So we got weakness in the relative strength line, the S&P 500 went higher. Then on a very short time frame right over here, we saw strength in energy relative to the S&P 500 and we saw that pullback. And then more recently, what we've been seeing here is the relative strength line coming off and S&P 500 really started to move here. So why was this important? Well, it's because if oil continues its rise here and consolidates and moves higher, and maybe even the 10-year yield moves along with it, that could mean, from an intermarket standpoint, if this starts to outperform the S&P 500, we may see some more digestion, more consolidation in the very near future of the S&P 500. Now, if I'm looking here at a quarterly chart, we just finished our quarter. We finished up at the upper Bollinger Band on the quarterly time frame. So it's really hard to make a bearish case here because we're seeing so much strength. The bearish case would be, yeah, we can pull back a little bit, which would be actually, in theory, that would be a bullish thing to take place, right? Because a consolidation makes complete sense when the market is going straight up. Now, if we look at the monthly time frame, same situation. We're kind of breaking out and we close at another monthly all-time high in the S&P 500. We're both above the monthly and quarterly 5 EMA, albeit we're a little disconnected on the quarterly time frame. So typically you'll get a connect. If we get too extended from it, we can snap back at some point. Now, if we take a look at the weekly time frame to get a little bit more zoomed in here, I just wanted to call, we do still have that negative divergence building in the S&P 500 weekly time frame, and we saw that happen right here. Okay, we had a higher high, and we had lower, weaker internals, and we saw it right here leading into the pandemic as well. So I just wanted to call that out. Does that mean we're going to have a similar situation where we pull like this or pull like that? No, that's not what it means, but it is something to just be aware of as the market presses higher. I don't think we should be shocked if it comes back in and starts to digest, consolidate, right? If we take a look zoomed in on this time frame, this candle right now is known as a gravestone doji, a shooting star, whatever you want to call it. Let me walk you through the psychology of it. It was very, very bullish, okay, right? It was a very strong week, and it turned completely around, and we closed flat to unchanged, slightly down, right, on the week. So it was a fight between the bulls and then the bears. They stepped up, meaning we have some indecision. So if we start to break the low of that, it could confirm that we can come to reconnect with the weekly 5 EMA, which is roughly at about 5,400. But be aware that we're still above a rising weekly 5 EMA there too as well. Now, if we take a look at like a year-to-date basis, clearly you can see why the market's at all-time highs. We have stocks like NVIDIA, arguably the most important name based off of implied volatility and market cap in the S&P 500, up 150%. Microsoft's up 20%. Apple just now recently in recent trades started to move up. It's up 10%. We have Amazon that's up 30%, Google that's up 30%, Meta that's up 42%. And these names, they're roughly at about their all-time highs here too as well. I found this chart to be quite interesting. If you look at the top 10 US companies, they just reached China's GDP here in 2024. So the top 10 US firms as far as total market cap, that's pretty wild stuff here. You can see total market cap June 25th, $18.2 trillion. Now, there are some divergences building if we get even more, if we dissect a little bit more into these markets. I like to look at this chart for every once in a while where we see strong moves. And we did see a strong move coming into month end, quarter end, okay, where the SPX TLT ratio, when that puts in a higher high and the S&P 500 puts in a lower high, I highlighted every time here. What you'll notice here is that's a signal that the market might be in for a period of digestion. We've seen it multiple times play out, and it's been quite effective. Now, in a very recent trade, right, we started to see this happen. So we'll see if it actually plays out, but that is currently what we are seeing on a very, very smaller scale. You might think, well, does this show bullish divergences too? Well, I can flip it over like this, and you can see on the flip side, if it makes a lower high, or sorry, a lower low, while we put in a higher low in the S&P 500, it's actually marked rallies in the S&P 500 multiple times there too as well. Another divergence is between dumb money and smart money, dumb money being the SPY, smart money being high yield bonds over here. We've called out many times where we've seen negative divergences and the market went lower. We're currently building one as it stands right now. And on the flip side of this too, I look for bullish divergences. So we called this one out here, right? As November was going lower and lower, bonds were not. So the smart money was telling us a story that we might get a rally. Even here on this recent pullback there, on the S&P 500, we saw that bullish divergence. The market went higher, and even more frequently into June, we talked about this one on our videos too as well, and the market pressed higher. So I think it's worth noting these divergences. They're not the end-all, be-all, holy grail, nothing is, but it's just one of those other tools. If you want to get really weird in divergences still, the housing market this quarter, it was down 9.11%, and lumber was down, the continuous contract was down 23%. Okay, so there is some interesting stuff taking place here, and the reason why I point that out is because if you do go back way to 2008, as the market kept on continuing to press higher, housing index actually peaked in 2005. Now, I'm showing you this on a much smaller scale on the daily time frame, that when you do see these divergences here where they put in lower highs in the housing market and the S&P 500 actually goes higher, it's actually led the market lower. And the flip side too, there's also times where you get bullish divergences. But the housing market right now is kind of just flat on its face, consolidating while the market continues to press higher. That could be an ominous sign, but it might not be. All right. If I take a look at equal weight versus the S&P 500 cap weight, obviously this too, right, is diverging from the S&P 500. Albeit though, the chart looks actually pretty bullish right here, right? It's getting very tight. So I'd be watching just in case for a breakout in equal weight, which means that we can see stocks that haven't been performing that well maybe start to perform, while maybe the other big names that we pointed out earlier, the large market cap, maybe take a back seat, right? If we also look at equal weight, though, the triple QE, right, versus the QQQ cap weighted, clearly it's diverging. This one's moving up, and then equal weight Qs are moving sideways. And this also, right, we're putting in higher lows right at this pivot line. It looks, I mean, it's not a bearish looking chart. I think we got to be aware if in case it does break down, but it is just getting very tight here. So you got to be also aware for potential breakout, which brings me to what can be potential opportunities in the market. I think that maybe mid-cap stocks may be a place to look. So I'm looking over here at MID, which is the S&P 400, the mid-cap index, and I'll just go over some ETFs too, and you could do your research as well. But some people want tradable products. But as you can see here, it is getting very tight from a mid-cap perspective, and we're 30-50 is right here. So to see if we break out and recapture the 50-day, I think that opens the door to come and try to retest and move higher here. Now, if it starts breaking down, obviously we need to be aware of that and watch out, because it is coiling up. And if I look at small caps, because other people will say, okay, what about IWM? What about small caps? Small caps are a little bit crazier, right? They're not as tight. They're a little bit more bouncier. So I kind of like how this is getting a little bit tighter. It's a little bit cleaner of a chart, okay, versus looking at SML, which looks like a chart basically of IWM. So what's a tradable product? Well, I mean, you could look at something like MDYG, which is a spider S&P 400 mid-cap ETF, or you can look at the holdings in these names to potentially get your eye on various mid-cap growth names, okay? And you can see this one right here, right? It's getting very, very tight. So if it breaks down, we can be for an expansion to the downside. But if it breaks up, I mean, this could offer up some opportunity. And then for small caps, you can look at something like the IWM, or we have SPSM, which is a spider portfolio of the S&P 600 small cap. Okay, and you can see, obviously, it's kind of choppy going around everywhere, but you do have some positive signs like a bullish crossover in the MACD. So you want to be aware that these things could go higher and potentially break down there too as well, obviously. I just like when they tighten up, it gives a good risk to reward. Maybe one thing that can really help with this would be something like the NYSE Summation Index. If we start to see the parabolic star identify a potential change in trend by clicking under this level. We did just get above zero in the NYSE McClellan Oscillator, and the last time we had a bullish crossover here between the Summation Index and the SAR, we did see a nice rally, and since that point, we had a sell signal, and it consolidated over here. So potentially the next buy signal might identify a potential change in trend where we can see these type of index products lead us higher. Now let's get even more tactical. Look at the S&P 500. On the 15-minute time frame, we'll use the SPY. Today, we saw a big move up on the PCE data. I'm not going to dig too much into that, but the market ended up reversing, closing underneath the 5-day moving average. Now, as we were above that today, right, it's one of those things where you got to be bullish, but with caution. Why? It's because look at the 5-day moving average. It was actually declining at that time to going neutral. So you got to be aware that it's very common to pull back in. Some people might call this a double top. It would be technically a double top, I guess, if you break down the low here, which would open the door to potentially lower as it stands, but we don't really have a bearish trend in the 5-day moving average. Now, going into next week, what's the expected move? Our expected move going into next week, the upper level is 550. 25 cents, so basically 550. The lower weekly expected move is 538. This week, surprisingly enough, I thought for sure we were going to tag a weekly expected move. We didn't. We came very close, and then we started to sell off. But I was shocked because of all the data, all the Fed speak, and it was a smaller expected move. I thought for sure we were going to tag it. Nope, didn't get it. We basically were unchanged on the week, came close, but that's about it. Now, going into Monday, we have 541 to the lower level, 547 to the upper level. That's what they're pricing in. We still have this gap beneath us here too as well. I think it's important to call out now because we're into a new month. It's going to be July. July's typically pretty bullish into like the mid of the month, so we might see some more upside action here. Don't get all too bared up. Or bulled up at that case, right? In the last video, we called it the great stall of 2024 because we're kind of coming into that period of time. But I want to give you the quarterly expected moves because we're going into a new quarter and the new monthly expected moves. So screenshot this, put it on your charts if you want these levels. This last month, we finished basically right at the monthly expected move. We came into it today. We bounced from it a little bit, very similar to last month, prior to this month, right? The quarterly expected move, 575. I'm just going to round up 576. The monthly upper expected move, 561. I'm rounding up. The lower monthly expected move is 528. And then the lower quarterly expected move is 512 and 50 cents per share. Okay, I'm going to go over to some gamma levels. Now, this will be updated on Monday. I'll post that into the Discord when the day starts. I usually give these gamma levels when they update. But there's something that had structurally changed, and I want to point it out. First and foremost, people started reaching for 5,600 even more. So that, at this current moment, as I'm pulling this up, that is the call wall, meaning traders want and are going for 5,600. This level is 5,500, and below that is not much going on up until really just 5,300 as it stands. So I think we got to be a little cautious if we start holding down under 5,500, and if we start breaking above it, I think that opens the door for us to try to go for that 5,600. So when I pull that up on a chart, notice here, 5,500 level, this is the pin we've been talking about for a long time, right? And you can see We were bound below it. We came into it. We broke above it, but we sucked back in. We came into it, but we pushed away. We came into it, we pushed away. We broke above, but it got sucked right back in. So price is really pinning here. So as the more open interest builds, we're probably going to see an explosive move from this at some time. So I think it's going to be key to watch the gamma flip line per usual. If we start breaking underneath that, I think that's what's going to open the door for a lot lower prices in the maybe about 5,400, right? To go test maybe the quarterly 5 EMA or maybe the monthly 5 EMA, but that is going to be that very important level there, along with 5,500. So I'm still of the sound that above 5,500 is bullish. Below 5,500, I think you got to be a little bit more caution, but you should be a buyer as long as we're holding above the flip line, which in this current moment, it's 5,450, because this is when dealers look to buy the dip, and they look to sell the rip. It's when volatility compresses, right? Or when volatility goes down, liquidity goes up. Now, I don't have the chart in front of me, but you'd have to go look at it through Twitter. But I did recently post a chart of the VIX, okay? The VIX daily time frame Bollinger Band width is getting very, very tight, which is not necessarily a bearish thing because you can see expansions in volatilities and the markets rise up, but you can also see an expansion in volatility and the markets fall too as well. But it is worth noting because an expansion in volatility means more wild price swings in the S&P 500. That's all I got for you on today's show, everybody. Hope it helps out. See you later.